This is when you put all your money into a coin all at once instead of spreading it out. Imagine you saved up $5,000 and decide to just buy Bitcoin today. If the market goes up, you make a lot quickly. But if the market drops right after, you could feel like you bought at the worst time. The good news is that history shows Bitcoin and major cryptos tend to go up over long periods, so lump sum investing often works out if you're patient enough. DCA means investing the same amount on a regular schedule, no matter what the price is. For example, buying $100 of Bitcoin every Monday. This smooths out your entry points so you don't stress over timing the market. Over time, you buy at highs, lows, and everything in between, which averages out. It's simple, consistent, and one of the most beginner-friendly strategies out there. This strategy is about waiting for drops and then putting money in when crypto is cheaper. For example, you might tell yourself you'll buy whenever Bitcoin falls 20% from a recent high. It feels satisfying to buy low, but the danger is waiting too long. Sometimes the price never comes back to your target, and you end up missing out on a whole rally. Cycle investing is about recognizing the big swings that crypto makes over the usual 4 years. After Bitcoin drops 50% from a peak, accumulation slowly begins. And if it falls even further, around 75%, that's when people start buying much more heavily. Then, later in the cycle, when everyone is excited, the news headlines are screaming to buy Bitcoin now, and your friends who never cared before suddenly want in. That likely signals it's time to start selling and taking profits. This, in my opinion, is one of the best long-term strategies you could adopt, and the one that will see you the most gains. This strategy means keeping most of your portfolio in Bitcoin, while only a small part is in altcoins, around 20 to 30%. The reason is simple. Bitcoin has the strongest track record and does multiple X's every cycle. If your altcoins fail to perform, Bitcoin acts like a safety net. Holding mostly Bitcoin from the cycle start will get you more than enough profits to cover all your altcoin positions, even if they somehow all go to zero. Rebalancing is the risk management strategy of adjusting your portfolio back to a set target. It involves periodically selling assets that have overperformed and buying underperforming ones to return your portfolio to its original target asset allocation. Let's say you want 70% Bitcoin and 30% altcoins. If altcoins pump and suddenly take up 50%, you sell some of them and move profits back into Bitcoin. It forces you to sell high and buy low without needing perfect timing. Swing trading is not full-time day trading, but it's more active than long-term holding. You try to catch swings that last weeks or months. For example, buying a coin at 40 cents and selling it a few months later at $1. It requires watching the market and having discipline, but it's less stressful than staring at charts all day. The risk is that you sell too early and miss a much bigger move. This strategy is about building up a stablecoin position as the cycle gets closer to its end. Instead of waiting for the crash to happen, you slowly rotate some of your gains from Bitcoin or altcoins into stablecoins. That way, when the bear market comes, you're sitting on cash that's ready to buy back in at cheaper prices for the next cycle. It's less about short-term timing and more about preparing for the long game. Instead of holding forever, you sell in pieces when prices rise. For example, maybe you sell 20% of your altcoin when it does a 2 or 3x. Because let's be real, if you can't sell a little then, you'll probably never want to sell if it ever reaches 10x. This strategy helps you lock in profits and de-risk your position without fully leaving the game. You still keep some exposure while rewarding yourself along the way. This involves always keeping some money on the sidelines, ready for dips. Think of it like an emergency savings account, but for investing. If a coin suddenly crashes 30% and gets back to, or even below the accumulation range, you have funds ready to scoop it up to increase your position and bring your average cost down. It's one of the simplest but most effective ways to avoid feeling helpless during a big correction. This strategy is as simple as it sounds. Just keep buying crypto and never sell, no matter what happens. It works best for people who don't really care about short-term moves or even their portfolio value during crashes, because the plan is to just stack mostly Bitcoin for decades. Trading cycles usually gives you higher returns, but holding forever is the most passive and easy approach. This is when you put most of your money into altcoins instead of Bitcoin. It's much riskier because while altcoins can explode 50 times, they can also disappear completely. If you did this in the current cycle and it hasn't turned out like you wanted it to, remember, next cycle, having a Bitcoin majority will probably save you some stress and make you sleep better at night. Altcoin majority is high risk, high reward, not for everyone. There can be, however, a slight exception to this rule that we'll talk about in the rotating strategy. Hedging just means protecting yourself if things go badly. Imagine you have a big bag of Bitcoin, but you're worried the price could drop. Instead of selling it, you can do things like buy an option that goes up if Bitcoin goes down. That way, if Bitcoin falls, your hedge balances the loss. Some people do this because they don't want to sell and trigger tax obligations, or because they're too exposed to just one coin and want to lower their risk. Bitcoin's halving happens about every 4 years, cutting the new supply of coins in half. There is usually a big increase in price after the halving, but it doesn't exactly start the bull run. It's more like the middle of it. In fact, this cycle was unusual because Bitcoin hit a new all-time high before the halving. The strategy is simple. Many investors like to stack Bitcoin before a halving and hold it afterwards, expecting higher prices in the months that follow. With staking, you lock up certain cryptocurrencies to earn passive rewards. It's like earning interest in a savings account, but with crypto. While Bitcoin itself doesn't directly stake, many investors who hold Ethereum or other proof-of-stake coins use this to grow their stack. The risk is that if when your coins are locked up, the market aggressively pumps, you won't be able to take profits. This strategy is like a smarter version of DCA. Instead of always buying the same amount, you buy more when the price drops to lower your average cost, and buy less when it's high so you don't raise your average too much. For example, if next cycle you want to average into Bitcoin and it falls from $50,000 to $40,000, you invest more to bring your average price down. But if it's already pumped to $60,000, you put in less money so you're not buying too high. Rotation is when investors move money from big safe coins into smaller altcoins as the cycle matures. For example, selling chunks of Bitcoin near the top to buy mid-caps or alts that haven't pumped yet. The idea is that money flows down the chain. First Bitcoin, then Ethereum, then mid-caps, then tiny coins. If you get it right, you can multiply your gains. This is where your portfolio can become more exposed to alts than Bitcoin. So it's important to pick some higher cap coins as well, and to not reinvest everything you've made so far. Leave some money aside for the next cycle. A moonbag is when you sell most of your position for profit, but keep a tiny piece just in case it explodes further. This way you are still exposed to potential gains, even after taking out most of the money. Imagine you bought an altcoin at $1, sold most at $5, but kept 10% of your stack. If it ever goes to $50 later, that small leftover can make you more than your original trade.